It's Financial Statements 101. We're going to cover assets, liabilities, and equity. Even though people like to write it assets, liabilities, and equity, I like to write it in the form of equity equals assets minus liabilities. So equity equals assets minus liabilities. I like to think about it in terms of if I was looking at myself, my own net worth, what I might have and what I might owe. So if we look at a company, we want to evaluate it with qualitative and quantitative metrics, just like how we might measure yourself, right? Your own career. What quantitative skills do I have? And also, what do I own? Like, what is my net worth, right? How am I doing financially? That's the whole point of financial statements, to understand how a company is doing financially. So how am I doing financially? Well, a lot of people would measure that using net worth. And then how do you calculate net worth? Well, that's basically what you have minus what you owe. If we look at what we have, well, what we might consider is definitely our house, things like our cars, and then maybe like, I don't know, our guitar, our Magic cards, Magic the Gathering cards. We don't really own it until we pay back those debts. What we owe might be our house mortgage, our car loan, our credit card debt. And similarly with a company, equity is basically the company's net worth. And that equals their assets, what they have, minus their liabilities, what they owe. This is simplified, but it's very accurate. If you understand this concept, you understand more than most investors out there. So looking at what you have in terms of a personal level, well, that's house, car, guitar, all your stuff. Well, a company might own like factories, they might own equipment, truck, patents, recipes, they might own other investments, right? And similarly, what they owe is they might be borrowing money to make these investments in data centers, to car building factories. They might owe a lot of debt to other banks, to other government institutions, for bonds. Any kind of debt would fall into liabilities. But you can pretty much simply think of it as equity, okay, is kind of like my net worth, and then assets and liabilities are kind of like what I have versus what I owe. A lot of people mistake, they see if there's a lot of assets, then that's like a good thing. Not necessarily. Even though assets has a positive connotation in terms of the word, it doesn't necessarily mean a good thing to have a lot of assets for a company. It does mean a good thing in terms of if another company wants to acquire this company, it's harder because there's a lot more in terms of assets for evaluation. But assets, having a lot doesn't necessarily mean a good thing. But having a lot of equity almost always means a good thing. Now I want to paint 3 scenarios on a company and personal level so you have a much clearer understanding of how assets, liabilities, and equities kind of change. So we're going to do 3 scenarios. So 3 scenarios, and then each of these we're going to track this at a company level and then also give a similar parallel scenario of a personal level. All right. So the first scenario is, let's say a company buys $1 million to build a tea shop, and to fund this $1 million, they use $500,000 in cash and they take a $500,000 loan. On a personal level, you can kind of think of it as I buy a $500,000 house and I take out a $400,000 loan or mortgage. For a company perspective, what happens to the assets? Well, now you have plus $1 million. You spent $500,000 in cash. You took out $500,000 in a bank loan. From a house perspective, you also took out, on a personal level, $400,000 in a mortgage. And on a personal level, well, great, now you have the $500,000 house, but you only took out $400,000 in mortgage, so you also spent $100,000 in cash. Now, the key thing here is, let's look at it from a company perspective, right? So now your assets have increased by $1 million into the tea shop, but decreased by $500,000 in terms of the cash. Originally, let's say this company had $500,000 in cash and that's it, right? So their total assets were $500K in cash. And let's say we had $100,000 in cash. Let's say originally we all had zero debt. So our liabilities originally were zero. And our equity, how do you calculate equity? That's assets minus liabilities. So the company would have had $500K in net worth, and you would have had $100K. Because again, assets equals liability minus equity. What is the equity now of the company? Let's look at what happens from the company perspective on assets, liabilities, and equity. So the company now has additional assets of $1 million for that tea shop. It originally had $500,000 in cash. The company spent that $500,000. And so doing some simple dumb math, now it has $0 in cash. It took out an extra $500,000 for the bank loan to get that tea shop. And so what is its equity now? Well, its equity is assets minus liabilities, what they have minus what they owe. And so their equity stays the same. It's still $500,000. Let's look at what happens on a personal level. So similar idea, I'm gonna roll through this. In terms of assets, we have a $500,000 house, right? And we originally had $100,000 in cash. We spent that $100,000. So now we have zero in cash. And we took out a $400,000 mortgage. So our assets are still $100,000 because it's our $500,000 house minus our $400,000 mortgage. So our equity now is still $100,000. So it started from $100,000 and it's still $100,000. Same with the company. The company started out with $500,000 and now it's still $500,000. So nothing has changed in terms of the equity or net worth. Now let's look at our next scenario. Let's say our company, because of that tea shop, they make $100,000 in profit. They keep $50,000 in cash. They use $50,000 to buy tea equipment. Our personal analogy would be, let's say you earned $100,000 from your job. You're keeping $50,000 in cash and you're using $40,000 to invest in stocks, and you're using $10,000 to buy Magic the Gathering cards. The company from before, it still has that $1 million tea shop, but now it has an additional $50,000 in cash and $50,000 of tea. You still have your $500,000 house, but now you have an additional $50K in cash and $40,000 in stocks, $10,000 in Magic the Gathering cards. So your assets have increased by $100,000. Similarly, the company's assets has also increased by $100,000. Let's look at what happens to liabilities. So what are liabilities? Liabilities are your debt, right? So did we take out any debt on this? We did not. So our liabilities for us and the company stay the same. What happens to our equity? Well, our company equity is originally $500,000, right? But this company earned $100,000 in profit. Where does that $100,000 go? Well, that goes in the company's equity, the company's net worth, and it's in a category called retained earnings. So originally, $500,000 and then plus $100,000 in retained earnings. That's how financial statements like calling this extra earnings or net profit. Now the company's total equity has gone from $500,000 to $600,000. And now your equity has gone from $100,000 to now $200,000. Because you're adding all your cash, stocks, and Magic the Gathering cards. Now, one thing to be wary of, are your Magic the Gathering cards and stocks really worth $10,000 and $40,000? Well, maybe not. Maybe they're worth more, maybe they're worth less. But when you look at your personal net worth, that's what you have to evaluate, right? Are my Magic cards, have they really depreciated in value just because I bought them and opened the packs? Similarly, when we analyze a company and look at a company's equity and net worth, we also need to be careful how accounting measures measure what something is valued at. Now, that's for future lessons and more advanced topics. Today, we're going to focus on the basics. So now let's go to our third and final scenario, just for illustrative purposes for you guys to get a good handle on this stuff. Let's say now the company, they've sold out a tea, they want to buy additional $50,000 for tea inventory. So what happens? Well, they originally had $50,000 in cash. So now all their cash has disappeared, but now they have an additional amount of tea inventory. And similarly, let's say you go out, you buy a computer at Costco. So what happens? Well, you spent that $1,000 in cash to buy the computer, but now you get a $1,000 computer. And so what you have is basically changed from cash converted to the computer. All right, let's think about the equity and liabilities. So equity and liabilities. Liabilities are your debt. Equity is what you own, your net worth, right? So what happens to the liabilities here? Well, the company purely spent everything using cash. So they did not take out any more debt. And similarly, you spent your cash. You did not take out any more debt either. What happens to your equity? Well, nothing changed, because all we did was switch one asset for another. The company switched cash to tea inventory, and similarly, you switched cash to a computer. Hope these three scenarios really helped you. And again, when you look at financial statements, don't get confused by the big words of assets, liabilities, equity. Think of it from this perspective in terms of equity is your net worth, and assets are what you have, but not necessarily what you own. And then liabilities are all the debts, what the company owes, similarly what you owe. So assets minus liabilities is equity. Equity is the key thing here. Higher amount of equity proportionally to liabilities usually is a good thing. In the future, we're gonna break down the specific line items of equity, assets, and liabilities, get more in detail there, and teach you more about financial statements. But this should be a good start. If you know this, you know more than most investors out there. See you next time. Cheers.